All right, time for case study number 1. We're going to examine the traditional whole life insurance policy in today's video. So when I say traditional whole life insurance policy, I'm referring to a pay to 100. And again, the 100 represents your age of 100. So when you see a traditional whole life insurance policy, typically what they are referred to as is a pay to 100 or pay to 121. Again, that represents how long the premium can be paid. A question that sometimes comes up is, do I have to pay the premium forever or until I'm 100 years old? The answer is no. You're actually going to see that in the case study we're about to look at. We're not going to fund the policy until this individual is 100 years old. In experience, most people don't want to fund a policy for that long. So we're going to look at the different setups here, options A, B, and C. What we're going to look at is the same dollar amount for each of them. We've got $100,000 per year going in. We're going to look at funding it for a long period of time. You'll see a lot of money going into this policy in total, but what we're going to examine specifically are the different designs. Now, in our last video, and a lot of our videos for that matter, we talked about this, designing the policy and really going over the differences of a policy where I have 100% of my money going toward the premium, or 50%, or 10% of my money going toward the premium. And if my goal is to maximize cash value, what I want to do is reduce that premium as low as I can based on the limits that the life insurance company offers and maximize this PUA rider in order to maximize the cash value while keeping my cash flow the same. That's the big thing there. So let's look at exactly that, again, with a traditional whole life insurance policy. So what we've got here is a policy with one of the major mutual companies, and this is the 100% base premium example. So we're going to go down to the supplemental values, and you'll see funding for 25 years. So $100,000 per year for 25 years is how much? If this is you, how much money have you paid into this policy? Well, 100 times 25 is $2.5 million when we look at it. So before we look at each example, if I'm considering this policy, my question would be this, and this is always my question for someone who's new to whole life insurance, which is this guy, where? Specifically, where is my money going? Because if we go back to the whiteboard, where can your money go? It can be directed toward the premium or toward your paid up additions rider, your PUA rider. Now you'll see different terms for the PUA rider with this company, but you won't see any column for the PUA rider up here because this is a 100% base premium policy. This column where we see base policy insurance represents, guess what? The base premium on the policy. So year 1, we can look at the annual net outlay column is $100,000. That's how much you pay out of pocket. You outlay money from your pocket into this policy. Scroll your eyes to the right. This column, net cash value end year, represents, you guessed it, your net cash value. This is your money column and how much money you have access to. Now, that $100,000 premium purchases you a sizable death benefit. You've got almost $6.4 million when you look at the total amount of life insurance here. But the first year, you've got 0. And this is based on the non-guaranteed values. We're going to look at the guaranteed values toward the end of this video. But year 1, you've got nothing to show for it. The reason why is because premium dollars with a traditional whole life insurance policy do not show up in cash value in the first year. And sometimes the second year. You'll see, again, based on the guaranteed values, that it's 0 in years 1 and 2, right out of the gates. And again, that's based on our premium dollars when we look at that money going in. So this is a great example of exactly what not to do, in my opinion, if your goal is to maximize cash value. But what I want to hit on here is this. So we have a sizable death benefit right out of the gates. Let me scroll up, actually. So the death benefit has a direct relationship to this guy. MEC stands for Modified Endowment Contract. We see a MEC limit of about $250,000. So what this means is that if this is your policy, you're paying a premium of $100,000 per year, and you have the ability to add an additional $150,000 per year into PUAs, because 150 plus 100 is $250,000. To be precise, this would be 148,764 into PUAs. The MEC limit is the maximum dollar amount you can add to a policy per year without triggering a modified endowment contract, which is a taxable event with respect to the cash value in a whole life insurance policy. I would check out the above video on designing a policy for maximum cash value for more information on how that works. So one potential upside to this policy is that you have some window room to add more money in the future. However, it is still, in my opinion, a great example of exactly what not to do. So let's look next at option B. So that was option A, what we just looked at there. Let's look at option B, which will be the same 100K per year, but 50% of the $100,000 directed toward the premium, and the other 50% directed toward PUAs. And you'll actually notice it's a little bit more aggressive than that. So let's take a look here. What do we see? An annual outlay column. Is that the same or different from the last example? It's the same, 100K per year. Is this the same or different? What was this in the last example? Not too hard to forget. It was a zero. I paid in 100 grand and had nothing to show for it. Here, I've got about $52,000 of what I paid into the policy in cash value, so I have more equity available. The reason why, going back to that question, where is my money going? Here, base policy insurance, that's the premium. So it's a little bit less than 50% in this example. And then here, scheduled AILR. AILR stands for Additional Life Insurance Rider. That's a term here for PUAs. I've got $55,000. So here, I'm reducing the insurance premium and redirecting more of my money toward PUAs in an effort to, you got it, maximize cash value. So as we look at this, is it better than the last one? Oh yeah, it's definitely better. Is it something you would want? Year 10, there's your break-even point. You've paid in $1 million and you have $1 million. Again, based on the non-guaranteed values. We're going to look at the guarantees in a little bit as we progress through this video. Now, before we go to the next example, what's different about this policy aside from the cash value? The death benefit, when we look at it. It's a couple $1 million less than what we saw in the last policy. Now, a lot of times when I point this out over the years, the rebuttal I always received was, I don't care about the death benefit. I want maximum cash value. Got it 100% with you. Here's why I like to point this out. I do know that you don't care about the death benefit. I'm not ignoring that. As you lowered the death benefit, what happened here? What's the death benefit have a relationship to? That MEC limit. In the last example, where your death benefit was well over $5 million, what was that MEC limit? Do you recall? Almost $250,000. Here, it's about 120. So what that means, if you're presently paying in $100,000 per year, let's do it this way, if you're paying in 100K over here, that means you've got room to add another $19,800 per year without triggering a MEC. So you can make a total payment of $119,802. Is this optimal? No. Is it better than the last example? Yes, with respect to the cash value. Now let's look at this guy. Same policy, same product, same individual. You'll see the health rating, out of pocket to him, everything's identical here, except for the actual cash values. So what do you notice here? What's your first year cash value? Not 0, not 50%, almost 84% right out of the gates. Where's the money going? Going back to that key question. Here you go. Premium, $10,000 clean. Now we've got Ailer, we also have Lister. That's a combination of a term insurance rider, and then money going into PUAs. Without getting into all the nitty-gritty designs that I like to talk about oh so much, we've got this policy with a minimized premium in order to maximize cash value. So, keeping our attention on the bottom line here, I'm paying in $100,000. There's my cash value in the first year. My break-even point is oh so close to year 6. I've paid in $600. I've got about $599. And then year 7, I'm positive. And this, by the way, is not a product we use a whole lot when maximizing cash value is the goal, but it's a great example to use because it's a traditional whole life insurance policy and an example many people see or have been exposed to. But keeping the products equal here, this guy is maximized for cash value. So here's the fun part here. If you said, this is my number, this is the most I ever want to pay into the policy. I don't want to commit to this. I want flexibility. You've got that because here's what you're committed to. The true minimum commitment is going to be closer to $11,000 to $12,000 because we do want to make sure we support the cost of the term insurance rider as well. But without getting into the details, we've got a minimum commitment and the ability to scale our payments up to $100,000 per year. So based on the insurance company limits, you can do that. What about the IRS limit? Well, here's your death benefit. Look at this. MEC limit, $100,000. Do you notice what happened there with the 3 examples? Every time we lowered our death benefit, we lowered that MEC limit. What we're aiming for here is an individual that said, here's my number. I want to be able to pay up to $100,000 per year. I don't want to get billed for it. I want to be billed for the minimum and have the ability to scale my funding up as the years pass. So we got a $10K minimum premium, $100,000 MEC limit, and that MEC limit has a direct relationship to the death benefit. So where we came up with that death benefit is by minimizing the death benefit as low as we can. That's the number we came up with in order to attain that MEC limit there. Let's look at a side-by-side comparison. And then we'll also look at the guaranteed values. Interesting stuff, but this helps people so much when they're trying to get things right and set that policy up for maximum cash value. So on the left, you've got the 100% base premium. What's circled here or boxed in these borders is your break-even point. So you see, year 1, you paid in $100,000, you have 0 to show for it. By year 14, you've paid in $1.4 million. You have just over $1.4 million in cash value. That's your break-even point. Let's look at the 50-50 example. So here we go. 50% premium, technically 45% if we go back to the illustration. But what do you notice here? About $52,000 right out of the gates. Break-even point 4 years earlier. Exact same product, just redirecting where the money is going. By age 65, when he stopped funding, by the way, what do you see here? There's a difference in value, isn't there? Yes, there is. And then let's look at the last example. That 1090 split, and here's what we'll do. So I'm going to get rid of the ugly one over there, okay? And just compare these two. So what we've got here, to the left, 50-50, to the right, that 1090. Cash value difference, death benefit difference. So the higher premium example does give you more life insurance initially, but you get significantly less cash value. Now there's something really important I want to hit on here. Well, first, before I do that, there's your break-even point much earlier. But as we look at this, what happens here? Eventually, I start to see this cash value difference go down. Now we got to go way down here. By year 25, I've got more cash value and death benefit in this example than I do to the example on the right. So more from start to finish with respect to the funding. That, during our working years when I want to access the cash value, does it for most people. But here's what I want to hit on. When we scroll down here, what eventually happens? Well, I see that the 50/50 policy begins to overtake that 1090 policy, and I've got more value here. Does that mean that it might make sense for some people to go with that 50/50 design? I would say no. And here's the big reason why. That's all based on the non-guaranteed values, and we've never seen that happen. It does multiply the agent compensation by 5 because they've got a 50% premium instead of a 10% premium. But here's the same thing, but based on the guaranteed values. So when we look at the guaranteed values, let's take this one at a time, actually. There we go. Here's your 100% premium on the left. When's your break-even point? You gotta scroll down. 29 years, you're cash positive. That's with a company that's always produced greater values than what's guaranteed, but still, that's a long time. The 50/50 design, break even between 16 and 17. Then we've got the 1090 design. What do you got here? Break even between 10 and 11. It's interesting, isn't it? The 1090, the break-even point in the guaranteed values is greater than the non-guaranteed values of the 100% base premium example. But what do you notice with the cash value difference here? That minimum base premium example always has more from start to finish. And when we look at actual results, meaning not illustrations, but policies that have lived the test of time, we see stories more similar to this, where the lower premium has resulted in greater cash value. But looking at the guarantees is something that is definitely beneficial. I like to look at them. I know a lot of people do as well. If we've ever got calls or meetings with CFOs or attorneys that are vetting the product for their clients, guess what comes up in question? The guarantees. Show me the guarantees. Would it be professional for me to say, well, the guarantees never happened, so let me try to talk my way out of showing them to you, or just brush them off? No. If someone requests something, show it. You can add your opinion, but make sure you honor their request first and foremost, because this is the client's money, not the agent's. All right, so let's wrap up with this, because from an awareness standpoint, we talked about what? The cash value is important, yes, but also the commission. So what you can do here, these are based on our rates, is we can see exactly what the commission is. So what I'm going to do here is this. The 100% base premium example. All base premium, a lot of stuff going on here. Here's all I want to hit. I'm just going to take the total commission. So we've got the annual here every year. First year, 93.5%, $93,000 and change. It's not bad. There we go. But there's your commission. And this is the total running commission in this example, not per year, because we're just taking the annual amounts and tallying them up. Now the 50/50 design actually had what? A $45,000 premium, not $450. So what this will do, actually balance it out, because there are commissions on PUAs. They're small, but there are commissions. So here's the 50/50 design. Now let's look at our 1090. All right. And if we go back to the design of this policy, what you've got is money going toward 2 different PUA riders, which the commission rate is the same with this company. So here we go. And commissions with most carriers stop after 10 years. Some will continue to pay a service fee, which is a reduced commission. But let's just go back to this. Let's make them all dollar signs. There we go. And look at that. You can see how it all works, especially when we're looking at what's guaranteed. The example with the least amount of commission results in the maximum consumer value when we look at the cash value and death benefit when we're looking at what's guaranteed here. Now, if you look at the non-guaranteed values, what you have is a chance that you might have more money long term, which again, I disagree with only because I've never seen it actually happen. I don't want to see just illustrations of what might happen if dividend rates go up with the higher premium. In my mind, that's saying, let me sell you a policy that is guaranteed to pay me more and might give you more long term. Because what if it doesn't? We've seen too many cases where policies have under-delivered and then the policyholder is left with less money. Like if I already got my money, it's like, all right, sorry. It's like, no. Do what is going to try to maximize value for the consumer if the goal is maximizing cash value. That's how I look at it. But anyway, I hope that this all made sense. If you do have questions, please let us know. Feel free to leave a comment below. You can also reach out to us directly via email, or you can visit our website. I do hope that this helps. In the next video, we'll look at case study number 2, which is going to examine the high early cash value product, which will be a lot of fun when we look at how it works. The commission is much different, but you'll see a lot of similarities compared to the Whole Life 100. We'll talk to you soon. Thanks so much for watching. Hey guys, Steve here with IBC Global. Thank you so much for watching the video. If you're interested in a whole life insurance policy and you'd like to work with our company in setting it up, please visit our website, ibcglobalinc.com. We would love to work with you. If you have any questions, please leave them in the comments below. And as always, I hope this helps.